The Doji candlestick pattern is a fascinating and important element of technical analysis. It is a single candlestick pattern. The Doji can provide valuable insights into market sentiment. This is especially true when it comes to the balance between buyers or bulls and sellers or bears. The Doji is easily recognizable on a candlestick chart. It has a small body, sometimes even non-existent. The wicks, which extend above and below the body, can vary in length. These wicks represent the price fluctuations throughout the trading period. The Doji signifies a period of indecision in the market. This is where the opening and closing prices are very close to each other. This price action suggests a stalemate between bulls and bears. Neither side can gain a clear advantage. Understanding the Doji pattern and its variations can be a valuable tool for traders. It helps them to identify potential reversals or continuations in the market. Remember, no candlestick pattern, including the Doji, should be traded in isolation. Always consider other technical indicators and market context for confirmation. The Doji candlestick is a powerful visual representation of market psychology. It tells a story of indecision and a potential shift in momentum between bulls and bears. Imagine a trading session where the bulls initially push the price higher. The bears then step in, driving the price back down. If the session ends near the opening price, a Doji is formed. This tug-of-war between buyers and sellers is crucial to understand the implications of a Doji. It suggests that the market is at a point of equilibrium. Neither the bulls nor the bears are in control. The Doji acts as a warning sign. It tells traders to pay close attention to the market's next move. Traders often interpret the Doji as a sign of uncertainty. It is a moment where the market is taking a breather. It is assessing the strength of both the bulls and the bears. This period of indecision can be short-lived. However, it can also mark a significant turning point in the market. The psychological implications of the Doji should not be underestimated. It is a clear indication that the balance of power between buyers and sellers is shifting. Traders should be prepared for a potential change in market direction. While the basic Doji pattern is characterized by its small body and varying wicks, several variations exist. Each type of Doji offers unique insights into market sentiment and potential price action. The standard Doji. This Doji has a very small body, almost resembling a horizontal line. The wicks are relatively short and of similar length. The long-legged Doji. As the name implies, this Doji has long upper and lower wicks. This indicates significant price swings during the trading period. The gravestone Doji. This bearish Doji has a small body at the lower end of the trading range. It has a long upper wick and little to no lower wick. This suggests that buyers pushed prices higher, but sellers overwhelmed them, driving the price back down. The dragonfly Doji. This bullish Doji is the opposite of the gravestone Doji. It has a small body at the upper end of the trading range, a long lower wick, and little to no upper wick. This indicates that sellers pushed prices lower, but buyers stepped in, pushing the price back up. The four-price Doji. This Doji is the most neutral of all. The opening, closing, high and low prices are all the same. It represents a complete stalemate between buyers and sellers. Each type of Doji provides valuable information about the balance of power between buyers and sellers. Traders should pay attention to these variations. They can provide early clues about potential trend reversals or continuations. When a Doji pattern appears during an uptrend, it can be a warning sign. It might be signaling that the upward momentum is weakening. This is because the Doji represents indecision. It suggests that the buyers, who were previously in control, are losing their grip on the market. The appearance of a Doji in an uptrend does not necessarily guarantee a trend reversal. However, it does warrant caution. Traders should look for confirmation from other technical indicators or price action. For example, a bearish engulfing pattern or a break below a key support level following a Doji in an uptrend would be a strong indication that the trend is changing. On the other hand, if the price continues to make higher highs and higher lows after the Doji, the uptrend may still be intact. The key takeaway is that a Doji in an uptrend should not be ignored. It is a sign that the balance of power between buyers and sellers is shifting. Traders should be prepared for a potential trend reversal. Section 5. Doji in downtrends. Potential reversal signals. In a downtrend, the appearance of a Doji candlestick pattern can be a potential signal of a trend reversal. This is because in a downtrend, sellers are in control. The emergence of a Doji suggests that their dominance is weakening. buyers are stepping in, trying to push the price higher. Specifically, a dragonfly doji appearing during a downtrend is considered a bullish reversal signal. This is because it shows that sellers were initially in control. However, buyers stepped in aggressively, driving the price back up to near the opening price. Similar to doji patterns in an uptrend, it's crucial to look for confirmation from other technical indicators or price action. A bullish engulfing pattern or a break above a key resistance level following a doji in a downtrend would be a strong indication that the trend might be changing. Traders should remember that no candlestick pattern, including the doji, guarantees a trend reversal. However, when a doji appears in a downtrend, it is crucial to pay close attention to the market's reaction. It could be an early signal of a potential trend change. Section 6. Doji in consolidation, waiting for a breakout. Consolidation phases are periods in the market where the price of an asset trades within a well-defined range. These periods are generally characterized by relatively low volatility and a lack of clear direction. Doji patterns appearing during these consolidation phases can provide valuable insights into the potential direction of the next breakout. When a doji appears within a consolidation range, it suggests that neither the bulls nor the bears are strong enough to take control. The market is at an impasse, waiting for a catalyst to tip the balance of power. Traders often interpret doji patterns in consolidation as a sign that a breakout is imminent. The direction of the breakout after a doji in consolidation is crucial. A breakout above the resistance level of the consolidation range often signals a continuation of the previous uptrend. Conversely, a breakout below the support level of the consolidation range often indicates a resumption of the previous downtrend. Traders should note that the appearance of a doji in a consolidation phase does not guarantee a breakout. However, it serves as a warning sign that the market is poised for a potential move. Traders should be prepared to act decisively if and when a breakout occurs. Section 7. Confirmation is key validating doji signals. While the doji candlestick pattern can be a valuable tool for technical analysis, it is crucial to remember that no candlestick pattern should be traded in isolation. Confirmation from other technical indicators or price action is essential to validate the signal and increase the probability of a successful trade. One way to confirm a doji signal is to look for subsequent candlestick patterns. For instance, a bullish engulfing pattern forming after a doji in a downtrend could indicate a higher probability of a trend reversal. Conversely, a bearish engulfing pattern following a doji in an uptrend could suggest a higher likelihood of a downward correction. Another method to confirm a doji signal is to analyze trading volume. Increased volume accompanying a doji can strengthen the signal. For example, a dragonfly doji forming on high volume during a downtrend could indicate strong buying pressure and a potential trend reversal. Conversely, a gravestone doji forming on high volume during an uptrend could suggest strong selling pressure and a potential downward correction. Support and resistance levels are also essential in validating doji signals. A doji forming near a key support or resistance level can increase the significance of the pattern. For example, a doji appearing near a support level in an uptrend could suggest that the uptrend is still intact. Conversely, a doji forming near a resistance level in a downtrend could indicate that the downtrend is still in play. Traders should always remember that confirmation is crucial when trading any candlestick pattern, including the doji. By combining doji signals with other technical indicators and price action analysis, traders can make more informed trading decisions and increase their chances of success. Section 8. Enhancing doji analysis with indicators. While the doji candlestick pattern can provide valuable insights into market sentiment, using it in conjunction with technical indicators can significantly enhance its reliability and provide a more comprehensive view of the market. Several indicators can complement doji analysis, offering traders a more robust approach to their trading decisions. The Relative Strength Index, or RSI, is a momentum oscillator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset. When used alongside a doji, the RSI can help confirm the strength of a potential reversal or continuation signal. For instance, a doji forming in an uptrend with an RSI above 70, indicating overbought conditions, could suggest a higher probability of a downward correction. The moving average convergence divergence, or MACD, is a trend-following momentum indicator that shows the relationship between two moving averages of an asset's price. The MACD can be used to identify potential trend changes and confirm doji signals. For example, a bullish crossover of the MACD lines coinciding with a doji in a downtrend could indicate a potential trend reversal to the upside. Bollinger Bands are a volatility indicator that consists of a center moving average and two trading bands above and below it. These bands are plotted 2 standard deviations away from the center moving average. They widen during periods of increased volatility and contract during periods of decreased volatility. Traders can use Bollinger Bands to confirm doji breakouts. A doji forming near the lower Bollinger Band in a downtrend followed by a breakout above the upper band could indicate a potential trend reversal to the upside. By incorporating these indicators into their analysis, traders can gain a deeper understanding of market dynamics and enhance the reliability of doji signals. The combination of candlestick patterns and technical indicators provides a more comprehensive approach to trading and can lead to more informed trading decisions. Section 9. Practical trading strategies with doji candlesticks. The doji candlestick pattern, with its ability to signal potential trend reversals or continuations, offers traders a versatile tool for developing trading strategies. However, it is crucial to remember that doji patterns should never be traded in isolation. Traders should always confirm signals with other technical indicators, price action analysis, and prudent risk management techniques. One common strategy is the doji breakout strategy. This strategy involves identifying doji patterns that form near key support or resistance levels, or within consolidation ranges. Traders would then enter a long position if the price breaks above the resistance level, or a short position if the price breaks below the support level. Stop-loss orders should be placed below the doji's low for long positions, and above the doji's high for short positions to manage risk effectively. Another strategy is the doji confirmation strategy. This strategy requires traders to look for confirmation from other technical indicators before entering a trade. For instance, a trader might identify a doji forming in an uptrend. However, instead of immediately entering a short position, they would wait for confirmation from other indicators, such as the RSI or MACD, before entering the trade. This approach can help filter out false signals and improve the accuracy of trading decisions. Traders can also use doji patterns as part of a broader trend-following or counter-trend trading approach. For example, in a strong uptrend, traders might look for doji patterns as potential entry points for long positions, while in a downtrend, they might look for doji patterns as potential entry points for short positions. Regardless of the specific strategy employed, traders should always manage their risk effectively by using stop-loss orders and position sizing techniques. The doji candlestick pattern can be a valuable tool for traders of all levels of experience. However, it is crucial to remember that no trading strategy is foolproof, and trading always involves risk. By combining doji analysis with other technical indicators, price action analysis, and sound risk management techniques, traders can increase their chances of success in the market. Remember, practice, patience, and discipline are crucial for mastering any trading strategy, including those involving the doji candlestick pattern.